Recessions are the best times to accumulate wealth. The current economic situation is turning into a once-in-a-generation chance to greatly increase your wealth. However, keep in mind that these opportunities may only last for a little while. Let's look at some recent news stories. 9 out of 10 CEOs are making preparations for a recession, and a lot of CFOs are reducing spending by 10%, while JP Morgan warns that the stock market could decline by another 20% from where it is now. Even though it may sound depressing and negative, recessions do occasionally occur. If we use the situation correctly, we can be prepared to take advantage of some amazing opportunities and discounts for the rest of our lives. The revered Warren Buffett once said that bad news is an investor's best friend. Let's discuss what's anticipated to occur over the next 12 to 24 months. Typically, recessions are accompanied by a sharp increase in unemployment, a decline in wages, a loss of consumer confidence, and a decrease in the value of nearly everything, including stocks, energy, food, and services, with some effects persisting globally for an extended period. Second, a recession lowers corporate profits. Latest quarterly earnings show slower negative growth, which further amplifies the effects of pinched earnings and employment slowdown and leads to more widespread layoffs. There is a significant decrease in aggregate demand as a result of the cumulative effect, and numerous businesses have been cutting back on employee numbers. According to Bank of America, the United States will lose about 175,000 jobs per month. What does all of this mean for your investments, and how can you use this knowledge to your advantage? Starting with stocks, all 3 major indices have decreased by up to 30% so far this year. JP Morgan's analysis predicts a further 20% decline from their present value. Since 1946, we can infer that the maximum bearish values were 30%, with the fall of 2009 being the worst, when the S&P 500 fell 57% from its peak. When the recession is factored in, these bear markets fall an average of 35%, and currently, markets are down about 25%. We know we have reached bottom when we see investors pulling back everywhere. This is the precise moment when things start to improve and allow for recovery. Let's discuss real estate. Every region is unique, and some may continue to have thriving housing markets, but declines on a national scale are extremely uncommon. There have been very few occasions in the past 60 years when prices have decreased significantly more than 10%. The worst downturn in national housing prices is expected to be between 10 and 15%, according to Wall Street consensus. If interest rates keep rising, different market reactions are expected. The most vulnerable markets, according to Moody's, may experience a 25% decline from their peak. This applies to areas of Idaho, Arizona, Florida, and Southern California, where the decline typically lasts for about a year and a half before bottoming out. For those with fixed mortgages who intend to stay in their homes for the next 5 to 10 years, this won't make a significant difference. However, if someone wants to invest in real estate, we should be prepared to see some specific deals which we'll cover shortly. The third aspect is cash. Cash is generally thought to be nothing more than a means of inflationary waste. However, cash can often be the least risky place to keep one's wealth when asset prices are falling. People may have overlooked it, but in 2018, cash was the best performing asset. If you had been saving your cash in high-yield savings accounts, you would have outperformed the market. Citigroup likewise asserted that investors can only use cash as a recession escape route. What can you do about this to make money? And why don't people usually take advantage of opportunities that present themselves? Here's what you need to know. The first factor that makes a recession a once-in-a-generation chance to increase wealth is that everything will become less expensive. When one would assume that now is not the time to make investments, a wealthy person would recognize an opportunity to purchase everything at a 30% discount when everything is dropping by 30%. The ideal comparison of that was provided by Warren Buffett. He said, "When hamburger prices go down, we sing, and when it goes up, we cry." Except for stocks. Everyone has the same opinions about everything in life. When stocks decline, investors can get more value. However, people no longer favor them, so you must convince yourself that even a declining market can be beneficial to you. The second thing is less competition. Companies cut back on expenses in tough times to protect their finances and be safe. On the other hand, it creates opportunities for smaller, more competitive businesses to set up and take their spot. A study of 16,000 businesses found that those that continued advertising increased their wealth and grew larger with strong growth after the recession. Third is that a bull market always follows a bear market. According to Yahoo, the S&P 500 has dropped 29% on average during recessions, but the stock that fell to its lowest level recovered at 40% the following year, and in a few years it was at 58%. This suggests that making investments when things are bad is more profitable than waiting for things to get better in the long run. This has historically proven to be true. Fourth is that you must take action before others become aware of the recession. It's easier said than done. Recessions appear to be safe to invest in, but they're never confirmed. Consider that it took until 2008 for the Great Recession of 2007 to be officially declared. The recession is always discovered just before it ends. So, what should you do? First, you should monitor your market, eliminate wasteful spending, run a lean operation, and keep reinvesting as much as you can into the market. Additionally, you ought to have a backup plan for what you'll need to do if your investment falls by 20 to 50%. How do you plan to compensate for the difference, and whether you might be able to take any preventative action before all this occurs? Second, you should hold on to some cash. Money is best used when it's invested, without a doubt, but having money in your pocket should give you peace of mind. To take advantage of good opportunities, an investor should have 15 to 20% of his portfolio in cash, depending on the season. Third, safeguard your career. This will serve as your best hedge no matter what. The worst-case scenario is not a decline in the market, but rather a decline in the market and simultaneous loss of employment. Fourth, concentrate only on long-term investing. Generally speaking, it's best to avoid investing any money that you'll need the next 5 years. The best course of action when investing is to simply carry on as usual. Dollar-cost averaging, or buying practices at periodic intervals, is one of the most successful long-term investment strategies, so stay in the market and keep buying. Fifth, diversify your investment portfolio. If you can't handle a 20% price drop well, chances are you've made aggressive investment decisions. For instance, if you've invested in American technology stocks, you should consider doing the same with real estate, where rents appear to be more stable. By doing this, your investments will have more stability and be less likely to crash. I hope you liked the video. Please like and subscribe to the channel for more content on investing.